Let's ask Gabriela Santos, the chief market strategist for JPMorgan Asset Management, as you see, live with us once again at Post 9. Nice to see you. Welcome back.
Thank you.
What a month it's been, and it's been broad-based. NASDAQ's up 5%, the S&P up almost 5%, Russell better than 5%, Dow's the laggard. But are we set up now for what may be a sweet spot?
I think we are seeing signs of that broadening out. One thing we do is we track the contribution to year-to-date returns of the 10 largest companies. End of January, 90%. It was a carryover of last year's story. Where we sit today is with only 74% of returns being driven by just a handful of stocks. So we're getting closer to what would be normal, which would be about 60%. So we are starting to see other companies participate within tech, other sectors, healthcare, industrials was a very strong
6.5%.
sector that we do like.
Yeah, industrials are up 6.5%, record high today. This is February. Discretionary 7.5%, 52-week high. Industrials record high. Tech record high.
I think it's been, for me, two big themes this month. The first, we know, there was a readjustment of expectations for rates just to more closely align with the Fed. But I think it's important to realize that high for longer is not the same thing as higher for longer.
Good point.
It was the uncertainty of how much higher we have to go that was paralyzing. I think companies can adapt just knowing what the cost of capital is, hence why stocks did well, even as rates reset higher. But the second big thing was earnings. And I think the better than expected end of the earnings season was really, really positive. And you started seeing sectors like industrial start to deliver better earnings.
Should we believe in a stat like this? Since 1930, the S&P has seen 16 cases in which the 4-month period from November through February were all positive, and the full year has been positive in all 16 cases. I mean, that speaks to momentum. It speaks to why perhaps we got here in the first place, and whether the trends that have been in place are going to remain in place enough that stocks can actually have a good remainder of the year.
Yeah, and I think it speaks to how low sentiment had gotten late October, right? It was that higher for longer. Is the 10-year going to 6, 7? What's going to happen with pockets of the economy? What's going to break next? Into now fully more appreciating that we can handle high rates and that you can have a soft landing or positive growth. So we do think there's a bit of a sweet spot here where growth is resilient, so good enough, at the same time that inflation's normalizing, but it's still there. So nominal growth is supportive of revenues, and especially as margins are stabilizing. What I worry about, though, Scott, for the rest of the year is eventually that narrative goes too far, right? We're still talking about being later in the cycle, which means really a focus on quality is still important. And it's too early to go after the kind of companies that are low quality or the kind of sectors that need rates to come down, which is actually what's up today. It's a bit early for that.
Can we be so late cycle if the Russell is just starting to get going? Like, if the Russell's going to start working, how can we be so late?
And it's a bit bizarre of a cycle. There are a bunch of different cycles within the cycle. But I think if you just look at one metric like the unemployment rate, below 4% for 26 consecutive months, that's a sign that we have little spare capacity, and that's a sign the economy's later in the cycle. But late cycle can last a long time. It just means that consumers are more focused on value. Companies need to be smarter about efficiency and cutting costs, and that companies that are bigger and have more cash on the balance sheet stand to do better. But that's not just the Max 7. There's other stuff there.